Barbara, thank you so much for joining us here at CAIS20. You were part of an impressive panel, all female I might add, talking about the acceleration of ESG into alternative investment. What stage are we at as we go into the 2020s?
So it was an amazing panel, and I think they covered it from a broad range of perspectives. The challenges are measurement, but increasingly institutional investors are demanding it, and this is conditioning behavior. As an institutional investor, I can't win a mandate unless I have an ESG policy, right? And then that, in turn, dictates the types of companies I can invest in. So that is helpful, and so we touched on measurement, we touched on some data, we touched on ESG policies, gender, and I'd love to get into all of those with you.
So if you can't change what you can't measure, how will data play its part?
Well, I think data is enhancing the measurement, and the fact that people are looking for these factors and assessing them critically is helpful. They say sunshine is the best antiseptic, right? And you take the data on any industry, and if we want to talk about the underrepresentation of women in our industry, women and minorities, despite their outperformance, manage just 1.3% of the assets in the hedge fund land. And this outperformance is stark. Bloomberg just put out a report last week saying funds run by non-white men are outperforming 2-1. Now, why is that? It's because 90% of the assets are with 10% of the managers. So 90% of the people are doing the same thing and expecting a different result. Right? And yet you have this tremendous alpha opportunity with these managers who are cognitively diverse, and yet because the minimum viable AUM of running a fund keeps escalating, they can't get break even despite their outperformance. And this causes the institutional investor trouble in investing in them, right? And so increasingly it's larger to back a big firm. And so what was interesting about this was we talked about BlackRock, and the audience was asked, did they believe this was just good PR? Was this greenwashing? And one of my panelists made a comment that, well, they didn't divest of a coal in their they divested of it in their active management, but not in their passive. And the panelists, sort of tongue-in-cheek said, well, it hasn't been performing anyway, so they didn't own it, or it's an easy thing to divest of, But it's a good start, and that was where we had consensus around, where some of the big institutions are moving on the matter.
And it is cognitive diversity, as you
Absolutely.
said, not just gender diversity. You've
Absolutely.
got to have people that think differently to one another to bring that success.
That's alpha.
How will that change? Because you said there that people can't invest if they haven't got the proven track record. Where does the tipping point happen?
So, in any industry, at its extreme, there's room for disruption. I personally believe that the barriers can be broken down. I think they're artificial. I think they're excuses. So, for example, if we can reduce the minimum viable AUM of a fund, and in my math, I can get it down to 75 million, so reduce it by half, then the smaller manager is sustaining, right? So smaller funds tend to outperform, by the way, 250 basis points a year. Cumulative is the statistic. But the smaller fund isn't profitable for the manager because the minimum viable AUM keeps rising. So if we can share the costs, and what I mean by that is the distribution and the operational cost, then the smaller manager is profitable, which means their returns are investable because they're sustainable, right? So I think by collectively coming together, we can crack this. So it's a terribly exciting idea, and so the other issue is institutions can't be larger than 20% of a fund's AUM, right? And they want a track record, and they can't do first-time funds, etc. But if they were investing in a platform that had several billion, for example, and then just pick the underlying managers, they're not more than 20% of these overachieving funds, and so now we've unlocked their alpha. So everyone wins.
So lots of exciting ideas and conversations that can be had at a conference like this, where people come together to bring those ideas through.
Absolutely.
What else do you think in terms of ESG? Because we touched on it briefly in the previous answer, but similar to the idea of cognitive diversity and measuring success, ESG is starting to show that it is beneficial to the bottom line. The figures are there. Where are we going in that direction, and is it going to be fast enough?
Yeah, so really interesting point, Emma. I don't think that ESG is just popular overnight. What I will say is over the last 18 months, there has been a far greater focus on it. 18 months ago, you could say you're an ESG investor and some people would roll their eyes. Today, if you say you don't believe in it, people roll their eyes, right? But why is that? And it's behavioral economics. In 1975, you had a Nobel Prize-winning economist, Milton Friedman, publish a seminal piece where he said the business of business is the business, right? It was shareholder capitalism. The only person that mattered was the shareholder. At the same time, in the mountains of Switzerland, there was this lesser-known professor yodeling away about stakeholder capitalism, where actually, yes, the shareholder matters. You can't be green if you're in the red, so yes, we have to make money. But shouldn't we also be concerned about the community? Shouldn't we also be concerned about the supply chain and their employees' well-being? And that was Klaus Schwab. And they have been at it for 35 years. But at the time that statement was made in 1975, intangible assets accounted for 18% of the S&P's value. Today, intangibles account for over 85%. So what is an intangible asset? It's not the replacement cost of your steel mill. It's trust, right? It's your pipeline if you're a pharma company. It's governance. It's all these things that take years to build and a tweet to ruin. And you only have to look at the share price of a Wells Fargo, of a Boeing, right? Of any of these, of VW, an Equifax. It's never been a more dangerous time to run a company unsustainably. It's not an option anymore. Your share price will get hammered. And so this is what's so exciting.
Is that you can have a real impact as an industry, and you actually should, arguably, as well.
Yeah. I mean, if your share price tumbles 30%, so does your stock option value. These CEOs are highly incentivized, right? I can't invest in you anymore if you're not being run sustainably. And so this is behavioral economics.
Barbara, thank you so much for sharing your insights. It's been fascinating to talk to you. Great to have you here at CAIS20.
Thanks, Emma.